Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 5th of March. I'm Daniel Lam, your host for the podcast. Earlier this week, we talked about how the conflict in the Middle East would lead to higher oil prices, which we believe would gradually normalize when the conflict de-escalates. But the length of the conflict would matter. The longer it lasts, the more damage it would do to inflation. Now, an energy-driven sell-off in bonds may turn into a macro-driven repricing. Hawkish Fed dot plot and the strong CPI print could push the US 10-year Treasury yield higher by 20 basis points to 30 basis points in the month of March. This is the most severe challenge to the current Goldilocks macro environment in the US. And indeed, there can be inflation surprises. We see rising prices paid and suppliers' delivery time components from the ISM manufacturing report. So this typically leads goods inflation by a few months, and now exacerbated by rising probability of an energy crisis from the tension in the Middle East. Higher energy prices would likely keep the Fed on hold, given inflation remains above target and leading indicators are heating up. Inflation and growth data had already been stronger than expected before the recent rise in the Middle East tensions. Should growth momentum continue accelerating alongside inflationary pressures, further Fed repricing would be required. Fewer than 2 cuts are now priced into the curve versus roughly 3 cuts a few days ago. As a result, US dollar has been strengthening, with the DXY index hovering around the 100 mark. Yes, this is partly due to safe haven demand, and partly because of the likely return of the use of US dollar as the settlement currency for energy products following the operations in Venezuela and Iran. A stronger dollar is a headwind to Asia ex-Japan equities and also EM assets in general due to the higher import cost involved and also the associated rotational demand for US dollar denominated assets. This also explains the most recent underperformance in Asia ex-Japan equities versus the US ones. We're expecting this to continue in the very near term. That's all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.